All right, welcome to our webinar sponsored by the Small Business Center Network and the North Carolina Employee Ownership Center on business succession planning with a focus on employee ownership. The North Carolina Employee Ownership Center is a statewide educational nonprofit with a mission to protect jobs, increase community wealth, and create a more vibrant, inclusive economy through employee ownership. And we do this through telling stories, forging partnerships, and providing unbiased information. So I'd love if folks can introduce yourself in the chat. Please share your name, your organization, the city and state where you're located, and your main goal for attending today. And I just want to welcome Katie Lyon. All right, so yes, if everyone can put in the chat your name, your organization, where you're located, and your main goal for attending today. And just to introduce myself, I'm Anne-Claire Broughton. I am the founder and the interim executive director of the North Carolina Employee Ownership Center. And I also run a nonprofit, Broughton Consulting, that helps businesses with succession planning. I'm an open book management coach, so training worker owners how to understand the profit and loss statement and the key metrics of business success. And then I also do some work around good frontline jobs and what makes a good job. So let's talk about succession planning. What is a succession plan? It is a plan for someone to own and run your business after you retire or exit. And both of those are important, ownership and also governance of the business. And the majority of small business owners don't have a succession plan. It's very exciting to start your business and to run your business, but people don't really want to think about what happens at the other end when you need to retire. Now, your exit strategy may not be about retirement. We see people doing succession planning much earlier in their career, but we do want to be prepared in case there are problems such as bad health or conflicts within businesses. We talk about the 5 Ds of death, divorce, disability, disagreement, and distress. We also saw a lot of businesses having to close suddenly during the COVID crisis. So big lesson here is it's really good to have a succession plan. It's really good to plan ahead. Hopefully you won't have some sort of crisis, but you'll be prepared and your team will know that there is a plan for what happens next. The other big demographic trend that we operate around is what we call the silver tsunami. So baby boomers own almost half of all the privately held businesses in the US, and 2030 is the year when all of those baby boomers will be out of the market. And so we call this the silver tsunami, and it is the largest wealth transfer in history. So it's about 2.34 million businesses owned by baby boomers, according to research by our partners at Project Equity. A very big impact on jobs, 24.7 million employees, payroll of $949 billion, and sales of $5.14 trillion. And it's in all industries all around the US. And so, you know, many of us value the businesses that are locally owned and locally rooted. And, you know, we want to make a plan to protect those jobs so that our entire economy is not big businesses that are located elsewhere. We have similar experience in North Carolina. So baby boomers own half of the privately held businesses with employees here. It's almost 79,000 businesses. 879,000 employees, payroll of $32 billion, and revenue of $165 billion. So it's very, very relevant to our state of North Carolina. And we worked with Project Equity to create this interactive map, which you can find on our website at nceoc.org under the Twin Business Crises. And the nice feature of this tool is that you can mouse over any county in our state and see the percentage of businesses owned by people that are reaching retirement age, what industry they're in, how many businesses there are. So in Forsyth County, about 3,000 businesses, and quite a big employee and payroll count. So this is a very nice tool that we have on our website. So let's talk about succession planning issues you want to think through. Definitely encourage people to start early, think through all of their options. You also want to think about successors in running the business, and you want to train them. We have seen cases where people will sell their business to their employees and then move to Florida and leave their employees kind of high and dry without the ability to actually run the business. So training your successors is key. Definitely want to plan for tax exposure, make sure your ducks are in a row legally, get financial advice, and then you really need to communicate with your team. So there are lots of succession planning options. A lot of people do have children that they want to leave their business to, or other family members, so that is a fine option. Many businesses sell to key employees, so there's a management buyout. There also might be an outside purchaser. That could be a supplier or a customer or even a competitor where there's some synergies. We are seeing investors and private equity firms that are purchasing businesses. You might just choose to close down your business. Although I spoke to a business owner this morning who said, had she known about employee ownership, she would much rather have sold to her employees than closed down. So employee ownership is an option that we'll be mostly focusing on today that can enable business owners to protect their legacy and protect the jobs and the community impacts. But strategic buyer, a lot of people think about selling to somebody who maybe is in the same industry or a similar one. Maybe they're willing to pay a little bit more because there's synergies with their business and yours. They may be able to pay a premium price, but they may not retain the jobs or operations. So there's a very good book that I recommend business owners read called Finish Big. And it's an analysis of a bunch of business owners who exited their business in different ways. And it talks about the ones that were the happiest. And the ones that were the happiest, as you can imagine, did retain the jobs in the communities. And the other thing is you may not be able to find a strategic buyer. A lot of people think that they will, and they hunt around, and maybe there is not a buyer in your geography or in your industry. But that is one option for succession planning. Another option is a management buyout. So maybe the management is able to borrow money to buy out the current owners over time. And that is a fine option that, again, protects your legacy, keeps things going the way they've been going, probably with a similar culture and way of operating. But some teams do not have the deep pockets or the ability to borrow. So this may or may not be an option for your business. Some people do want to transfer their business to a family member. You want to definitely think about your tax implications if you do this. And then you definitely want to make sure that the individuals want to run your business and have the skills that you need. I definitely recommend if you bring a child into taking over your business that you make sure they get the experience they need. Maybe work in a different business and then come into your business with skills and experience, because your team may be resentful if you bring in someone who's not experienced. So that's a perfectly good option. But today we are going to focus on employee ownership. So employee ownership is a business model in which employees collectively own a percentage or all of the business for which they work. Benefits of employee ownership: you preserve your legacy, the jobs, the people who have worked hard to build this company, the community impact. You reward those employees. There can be beneficial tax treatment for some forms of employee ownership that we'll review today. And then there's a lot of research that the National Center for Employee Ownership and the Rutgers School of Labor Relations have done that show that employee-owned firms that have a very strong, engaged culture perform 8 to 10% better and have much better employee attraction and retention rates. So these companies can be more productive. They have lower turnover. They have been more resilient during downturns. They tend to last longer. They pay workers better, give workers more voice. Businesses that are located in communities as opposed to located elsewhere spend much more. I think it's 70 cents of the dollar stays in the local community as opposed to only 30 or 40 cents with a business that's located elsewhere. And they tend to be more engaged with the community. And there's an ability to actually build some wealth that stays in the community. So again, 2% higher sales and employee growth year after year. Employee owners 6 times less likely to be laid off and 50% less in the last 2 recessions, according to Rutgers. Very attractive workplaces that give individuals a chance to actually think like an owner, build some entrepreneurial skills, and build some wealth. Right now, your average employee only has about $400 in savings, and many don't even have that. So if there's a sudden crisis, they do not have the resilience to get through that. And so employee-owned businesses tend to pay people better and give them the opportunity to build wealth and hold on to their jobs for longer. And this also affects folks that have sometimes been left out, like non-college graduates, parents, workers of color, single women, etc. These companies offer better benefits such as medical insurance and life insurance, maternity, paternity leave, tuition reimbursement, flexible work schedules, and childcare. And then wealth accumulation. So again, 4 in 10 Americans don't have $400 on hand for an emergency. So workers at an employee-owned company, some of them build individual accounts that are worth 5 or 6 figures. And this is significant at this time when the wealth gap is increasing and actually has reached feudal levels. And then wonderful community impacts. So it's a triple win for the owner, the workers, and the community. So what do you want to think about when you are considering selling to your employees? The company does need to be privately owned, does need to be profitable in a good, healthy industry with some cash flow. We don't want to sell distressed assets to our employees, excuse me. Helps to have experienced advisors, and there are many tried and true advisors that our Employee Ownership Center can point businesses to. There can be tax benefits to the owner and the company, and it can definitely be a way to attract and retain employees. So we have a proven record here in North Carolina. There are 160 or more firms headquartered here that are wholly or partially owned by employees, and 750,000 or more current and former employees that are benefiting from employee ownership. These are some logos that may be familiar to you. So this is a combination of all forms of employee ownership, but companies like Salem Fabrication Technologies, our state magazine, many people may not know, is an ESOP. The Mast General Store is a chain that many of us love. Measurement Incorporated, the Quaintance Weaver Hotels, so the Proximity Hotel and all those restaurants in Winston-Salem, those are all ESOP. We have some amazing cooperatives like Putter Emma in Asheville, Opportunity Threads, Electric Violin Shop we'll talk about, the Senzantle Language Justice Cooperative, So True Seed, the Durham Co-op Market. And then we have one fantastic employee ownership trust. So these are businesses, names that many of us know and are familiar with. Atomic Object actually is employee owned through employee stock purchase plan. So wonderful employee owned businesses that, and there's many, many more that we rely on. So let's talk through the 3 types of employee ownership, the 3 main types. So the number one most common form of employee ownership is the employee stock ownership plan, or ESOP. There are about 6,533 ESOPs in the US. There's actually fewer than there were a few years ago, but that is because there's been a lot of mergers and acquisitions in the ESOP space. And so there's more participants. There's about 14.7 million participants in the ESOP space. And ESOPs have been around for 50 years or more. Very well-established form of employee ownership. Many stories of participants who retire with 5- and 6-figure accounts that can change trajectories of whole families, as well as providing great exits for business owners. So that's our most common form of employee ownership. Then we have worker cooperatives. There's many types of cooperatives. There's grower cooperatives, electric cooperatives, producer cooperatives like Ocean Spray, member cooperatives like REI and some of our local food co-ops. But we're talking here about worker cooperatives. So these are businesses owned and controlled by their employees, their workers. And there's a growing number of worker cooperatives in the US. So the most recent figure I have is about 612 worker cooperatives with between 6,000 and 10,000 participants. And then the newest form of employee ownership in the US is the perpetual trust or employee ownership trust or EOT. And there is a database of the ones that we know about so far. There's about 50 in the US and there's more underway. And Katie actually works for a firm that is building more employee ownership trusts. So we'll see a greater number very, very soon, but there's more or less 50 that I know of. So going through one by one, what is an employee stock ownership plan or an ESOP? So it is an employee benefit plan that is regulated by federal retirement law or ERISA. So it's an employee benefit plan that can set aside or borrow funds to buy the selling shareholders shares of company stock. And those shares are put in a trust in a very defined way. They're allocated to individual employee accounts that vest over usually about 5 years. And then they're cashed in when the employees retire or leave the company if they're fully vested. And there can be significant tax benefits for both the selling shareholder and 100% ESOP owned companies. Couple of very prominent ESOPs in North Carolina are Salem Fabrication Technologies Group, which has been an ESOP since 2002 and has a fantastic ownership culture where the employees are super bought in, and they're doing very, very well. And then Columbia Forest Products. I think they're the 64th largest ESOP in the US. They became partial ESOP in 76, full ESOP, I believe, in 84. So this is a form of employee ownership that is tried and true. So let's talk about considerations for an ESOP. You can start gradually if you sell at least 30% of your shares to an ESOP, then, and your company is a C Corp, the selling shareholder can defer capital gains taxes indefinitely if they reinvest in certain securities. So that can be a very nice benefit. And if you sell 100% of your shares to the ESOP, you can defer capital gains on 100% of those gains. And then once a company is 100% ESOP, if it transitions to an S Corp, then that company is tax exempt. So that's also very attractive for companies that, want that cash flow to grow, do some mergers and acquisitions, and create more value for their employees and their community. Certainly ESOPs can boost company performance. Again, you can't just convert to employee ownership of whatever sort and expect employees to get it. You've got to do some sort of training, education, participatory management, such as open book management, can really, really boost the performance and the understanding of the employees. Now, because ESOPs are regulated by retirement law, you need a larger company. Some people say it needs to be up to $1 million in EBITDA or profitability. I've seen slightly smaller ones, but you need to probably have at least 10 to 20 employees. You need strong cash flow. You need to be big enough to be able to afford the administration that is required to comply with ESOP rules. So there is an annual valuation. You do have to have a trustee and an administrator. So, there's some complexity, but there are many, many professionals that are super experienced with setting these up and running them and advising companies. So if you're a larger company, this can be a fantastic win-win for the business owner and the employees and the community. All right. If there are no questions about ESOPs, we'll move on to worker cooperatives. So a worker cooperative is a business entity, could be a corporation, an LLC, a trust, depending on state law. A lot of the ones in North Carolina are LLCs, but it is owned and controlled by its members. And it is governed by bylaws that very clearly address how members join or leave the co-op and how the profits are distributed, and also how the governance works. What things do we run in a more traditional way, and what things do we have a vote on by our entire membership? It is not generally a complete free-for-all, everything runs on consensus, but we spell out in the bylaws exactly what decisions are decided how. It operates on the principle of one member, one share, one vote. And, you know, there is generally democratic governance. And I'll tell you a little bit about a couple that we've been involved with. So you can potentially have the 1042 rollover that you get with an ESOP for selling to a co-op. I have not yet seen a transaction that's big enough to trigger the 1042 rollover, but it's potentially there. We've seen co-ops of all different sizes. The largest one that I know of is the Drivers Cooperative out of New York City. Last figure I saw was about 9,000 worker owners at the Drivers Co-op. But it also can be a good fit for smaller companies. And that's the couple that I'll tell you about that we've been involved with were smaller companies. But there are co-ops of all different sizes. And it can work well with a pretty flat organization, highly motivated employees who know the business. There definitely are fewer administrative hurdles than an ESOP. You don't have to do an annual valuation. You have to do one at the time of the transaction, but there's no annual valuation. It is a more democratic structure, but unlike with an ESOP, where members are granted their shares, there is a cost for employees to buy in. And that could range anywhere from $100 to $10,000, but typical co-op shares are $3,000 to $5,000. And that is generally deducted from your paycheck over time so that it's not too painful. And you are a full co-op member as soon as you're voted in, even before any of that share is deducted from your paycheck. And just to be very, very clear, the employee membership shares do not pay for the transition from the selling shareholder to the cooperative. That can be paid for through a bank loan, through cash flow of the business. These shares can be used for working capital, but it is this is the buy-in for the co-op. So those are two different financial transactions. So a couple of transactions we've been involved with. Electric Violin Shop is a small boutique retailer in Durham here, where I'm located. And the owner was out of day-to-day operations already. He was looking to exit and he was looking for a buyer. So he hired us to help him out to look for a buyer, but he was really too small for an outside investor or buyer. So because there was already a capable staff of 4 or 5 people managing day-to-day, we suggested a worker cooperative. And we looked into it. The owner got more and more excited about it. We were able to get some outside financing from the seed fund. And so it was a combination. Most of these transactions are a combination of some liquidity up front, some cash at the time of the transaction, and then probably a seller note over 5 to 10 years. So we were able, with the help of this, with the seed fund, to do this kind of 2-part financing, and the business several years later is doing great. The owner's happy, the worker owners are happy, the customers are happy to have this fantastic business still around. And then So True Seed is another that we were involved with. So they're a heritage seed company based in Asheville, North Carolina. They've been around about 10 years, kind of breaking even, but during COVID, a lot of people got excited about growing their own food. And so they became much more profitable and then had more options. The owner was at retirement age and really looking to exit. And so they had a very capable staff that were already managing day to day and already looking into more democratic management. They have a very flat management structure. And so we were able to get a valuation that everyone agreed on. And this one is mostly seller financed, although I think after a few years, the business plans to take out a loan to pay off the remainder of the seller financing. All right, any questions about worker cooperatives? So hearing none, let's talk about the employee ownership trust. So that is relatively new to the US, but it's the predominant form of employee ownership in the UK. So the John Lewis Partnership has been an employee ownership trust for 100 years. And in the case of an EOT, a trust holds shares of the company on behalf of the employees who participate in annual profit sharing. So you form a trust and it can actually be gifted all the shares of the company. So it becomes the only shareholder. And it is not a retirement plan. Employees don't have their own, they don't actually have equity in the business. They are profit sharing only during the time that they work there. So some people say naked in, naked out. When you work at the business, you're entitled to profit sharing. And when you leave, you're done. So unlike ESOPs and co-ops where you need to pay out someone's retirement account over a few years. And it is regulated by state trust law. So a couple of states, Delaware and Oregon, have perpetual purpose trust legislation and very specific ways that these perpetual purpose trusts need to be set up. And some states like North Carolina, we are just operating under state trust law. And the purpose of the trust could be something like the environment, as was the case of Patagonia's trust, or in the case of these employee ownership trusts, the beneficiary of the trust is the employees. And US trust law changed around 2004. Excuse me, to enable an idea, such as the employees, to be the beneficiary, as opposed to Jane Smith. So one reason why these trusts have been catching on is because they enable a company to be employee owned in perpetuity if that is the desired outcome. Because an ESOP could be sold if there were an attractive enough offer. So we've seen ESOPs such as New Belgium Brewing and some others that got a very good offer and they sold. And so they were no longer employee owned. So this was one consideration. They are very flexible. They're not regulated by retirement law. And so it's much less expensive to set them up and to maintain them. You don't need to do an annual valuation. But then on the other side, there is no favorable tax treatment for employee ownership trusts or other perpetual purpose trusts. And just like with a co-op, you would set up a set of governing principles. And so you could set it up in the way that the selling shareholder and the business worker owners feel most strongly about. So it does allow for a lot of participatory governance. I don't know if Katie, if you want to add anything from your experience about perpetual trusts. Some people have another purpose. So the organically grown company in California, I think, or Oregon, wanted to benefit their growers as their grower partners, as well as their employees. So an employee ownership trust was much more attractive to them than an ESOP.
I think you covered it, Anne-Claire.
Fantastic. So the one EOT that we have here in North Carolina is ShopBot Tools. So they're a small manufacturer with 35 employees. And when we started talking about succession, it really made sense for them to engage their employees and to increase their margins. So they implemented open book management first. They really took a close look at their financials, figured out where they could be smarter with costs and grow their revenues and get all their employees thinking like owners. And so they got that good structure of involving everyone to think about the numbers first. And then they started looking into employee ownership. And they did a study to see if an ESOP was a good match, but they were just a little bit small for an ESOP. And the founder, Ted Hall, was excited about the possibilities with an employee ownership trust. And so we worked with Chris Michael and some other advisors and set up their very unique EOT. And this one, there is no outside financing. It's 100% seller financed. And so there's a 10-year note for the company to buy out the shareholders. And every year, a tenth of the note is retired. And this one closed in 2021. And so they already had some broad-based profit sharing through their open book management. And once the shareholders are all paid out, the former shareholders, the note holders, there will be additional funds available for profit sharing. So this is the first one in North Carolina. We learned a lot. We also created a side-by-side governance document, created a governance structure for the employees. The board of directors is moving towards 1/3 outside directors, 1/3 management, and 1/3 employees. So we created this structure. We created an employee committee that is educated about open book management and about the trust, and they help educate everybody else. So they are the first one here, but we are working on several others. So this is a nice chart Project Equity put out that compares some of the aspects of ESOPs, worker cooperatives, and employee ownership trusts. So you can see that you really need a larger company to afford an ESOP, whereas a worker co-op and an EOT could be any size. Tax benefits, the 1042 deferral of capital gains almost always applies for an ESOP, sometimes applies for a worker co-op, but it's not available for an EOT. Tax benefits, again, if you're 100% ESOP S Corp, you are tax exempt. Worker co-ops, there is some tax deduction for the patronage accounts, the employee accounts. And for EOTs, there can be a tax deduction for profit sharing. Setup and ongoing costs, pretty high for ESOPs, could be anywhere from 90 to 150,000 to set it up. Much lower for worker co-ops and EOTs. Flexibility, the ESOP has very specific parameters. Co-op has parameters. EOT, super flexible. We've seen a bunch of different ones in different states that have different priorities. And so, yeah, we've set them up in very different ways. There is one resource so far, this book by the NCEO about EOTs. I'm sure we will see an update of this book and several others. So yeah, a lot of us have been getting together to try and streamline the EOT experience so that we can just standardize it a little bit. Employees do buy their shares in the case of a worker cooperative, not in the case of an ESOP, and there are no shares in the EOT, that is profit sharing. The role of employees in strategic decision making, for sure, you will have that in a worker cooperative. And you may have it, you have the option to set it up for an ESOP or an EOT. You can do a partial employee ownership transition in all cases. And there is some degree of built-in profit sharing, certainly for EOTs and worker co-ops. Employee stock ownership plans, there are some where they have a profit share for short-term gains as well as the long-term gains through the ESOP, but it's not built in. So this is just a nice way to kind of compare and contrast. So speaking of phase transitions, some selling shareholders do phase it in. For an ESOP, 30% is a good place to start because you can get the tax benefit if you start with 30%. Some people start with 10%. I have seen people Business owners sell up to 49% of their business to employees and holding on to 51%, which gives them control for a little bit longer and gives them time to train their employees, educate the employees. It also breaks up the financing into several smaller amounts. So some people go 100% right away, and some people break it up into 2 or 3 or more phases. So questions for business owners to ask themselves. Just at the very beginning, where do you see yourself in 5 to 10 years? I love it when younger business owners start asking these questions and just get this process going sooner. And then where do you see your business in 5 to 10 years? And do you have family interested in taking over the business? We had one ESOP client who absolutely did not want their family to take over their business. So when they found out about employee ownership, they jumped on it. And do you have employees that are interested and able to take over their business? You know, many employees, especially younger ones, are quite excited about being very engaged and running a business. Some people just want to show up and punch the clock. So you need to kind of take the temperature of your workforce and see if there's folks that are interested and are able to get up to speed to take over the business. And then you want to evaluate the business. So do you have a history of strong profits? Do you have a solid customer base? Are you in an attractive and growing industry as opposed to one that is phasing out? How is your location? That does unfortunately make a difference. How are your assets, your facility, your machinery, your inventory? Do you have good supplier relationships? And then I always have business owners think about, what is it that you bring to your business that is just you? Are there certifications that your business is dependent on that only you have? Because if so, you need to start training other people to have those certifications. And is it reliant on your personal skills? Most frequently, business owners are the kind of rainmaker. They are bringing new business. They are the innovator and the strategic person. And we've actually seen this in transitions for very large businesses where your founder, your rainmaker, your creative innovator retires, and the person succeeding them is your implementer. And that business is not going to last. You really need somebody who's going to innovate and think strategically. So you really want to think about, take inventory about what do you bring personally to the business, and who can you train in your business to fill those gaps? And if not, who do you need to bring in? And then how is your balance sheet? Do you have a lot of debt? Do you have accounts receivable you can collect? How are your retained earnings? Because that will be a big part of valuing your business. And that's step number 1, is to get a business valuation to see if you can afford any kind of these transitions. So the 3 phases of business succession are learn and prepare, number 1. So learn about all the options. And we talked through at the beginning, you could sell to your employees through a management buyout. You could have a strategic buyer. You could have a family buyer. And you could pursue one of these 3 forms of employee ownership. So ESOPs, worker cooperatives, and employee ownership trusts. So learn about these options. I have a list of resources at the end of this presentation. There's websites such as ours, the North Carolina Employee Ownership Center, but there's many others, the National Center for Employee Ownership, ESOP Association, Project Equity. There's one called Becoming Worker Owned or Becoming Employee Owned, Democracy at Work Institute. There's tons of resources out there where you can read about the options. You can watch videos. And then there's conferences and meetings where you can talk to other companies who have gone through similar transitions. Definitely ask those other business owners, what were you thinking about? Why did you choose the option that you did? How did it work for you? Decide on your timeline. So 6 months is about the shortest that you could expect to get from start to finish, but that means you've already got all your ducks in a row. Your financials are good. You've got your succession plans. You've figured out your good option. You've figured out the financing. Maybe you can do it in 6 months. It's probably going to take a little bit longer than that. So think backwards. When you want to be out of the business, or at least you want the ownership to have transitioned, because some people stay in their business for longer, and then work backwards from there. And really make sure your financials are in order. I did talk to one business owner who was paying his employees under the table. So you got to make sure everything is in order financially before you can even start any kind of business succession plan transition. And then step 2 is evaluate and plan. Conduct a feasibility study, run the numbers. And there are a lot of professionals out there that can help you. And they normally, a lot of them will do the feasibility study for a low charge or no charge. So get that feasibility study done for whatever option or options you're thinking through, and make sure it makes sense financially. Then, like I said, you've got to conduct evaluation. There are a number of organizations that do valuations. A lot of our clients have had evaluation done within their specialized industry. So for example, the electric violin shop had a music business conduct their valuation because they understood that music industry and they could do comparables. So it can be very, very helpful to find maybe an industry association that offers valuations in comparable industries. But you need that valuation. Then you definitely want to consult your attorney. There's a number that are experienced with the various forms of employee ownership that we can point you to. You want to get tax advice for sure. And then if you need outside funding, there is bank funding. There's some other funding available for things like ESOPs, worker co-ops, and EOTs. And then step number 3 is train and communicate. You definitely want to train your successors to fill all of those roles that you have filled as the business owner. And you want to talk to your customers and suppliers and transition those relationships over to, if you are leaving the business, over to your successors. Again, there was one business that my colleagues worked with where the owner sold to his employees through a worker co-op and then took off to Florida and left them high and dry. And he had been running it very top down. And so they were kind of lost. But luckily, my colleagues were able to support them and they're doing well now. So really training those successors and transitioning those relationships is key. And then you want to communicate. So that's tricky, right? You don't want to communicate too soon. You don't want to say, well, in 6 years, you're going to own this. You probably want to talk through your options, make a decision, but we often are brought in to talk to key employee groups or management teams about whether it makes sense for them to become employee owners, and are they 100% behind it. So you may start with your management team, and then once you've made a decision, it may be time to communicate to employees. And in some cases, like with the worker co-op, you will have an employee team that helps manage the transition. I did talk to one fellow who he actually took over the business from his dad. And it was about a year later, he realized that nobody knew that he was running the business. And so then he built a communication plan and made sure everybody understood the ownership and the governance of the business. He just took it for granted that everyone knew, but they did not. So communicating to employees at the right time is key. All right, so those are the steps to employee ownership, and I'll just let you know what we offer at the North Carolina Employee Ownership Center. So we were founded to provide education and outreach, agnostic about the type of employee ownership, but about all types of employee ownership to the entire state of North Carolina. So we do webinars like this, we do trainings, we do events, we do one-on-one business advising. We refer people to the right partners that can help them with whatever form of employee ownership they've chosen. And then we also do some research and policy, like the data that I showed you at the very beginning on the number of employee-owned businesses in our state. Recently, there was a bill passed that enables ESOP companies to maintain preferred status in government, government contracting, like HUBZone status. So we're involved with policy to a degree as well. Some events coming up that we're offering, we've got an employee ownership ambassador program, and that might be a really good thing for a lot of the small business counselors in the state to participate in. So we are partway through our August cohort. Katie is actually going to be a speaker next week. But this educates anybody who touches businesses, could be business owners, advisors, wealth advisors, lawyers, accountants, Chamber of Commerce executives, economic development professionals, on the 3 types of employee ownership. They will hear from a service provider and a couple of businesses that chose that option, and have a chance to do a deep dive in terms of learning about those types of employee ownership. So we do have a second cohort for September coming up. Definitely encourage people to register. And then we have 2 more webinars in this series. There's going to be an employee ownership deep dive with Salem Distributing on September 17th. And then we're going to do a webinar on employee ownership as a way to attract and retain great employees. And that'll be October 15th. And then our big in-person celebration of employee ownership is October 24th in Winston-Salem at Footnote Coffee and Cocktails. So we'll be celebrating all of the recently converted employee-owned businesses in our state, celebrating our new employee ownership ambassadors. We have an employee ownership company of the year, and we're hoping to bring some legislators in to celebrate employee ownership as well. And here are some resources I've got for you. So, of course, our center, we have a lot of videos and stories about employee ownership and resources. The Industrial Commons is based in Western North Carolina. They go very deep in the textile industry and in larger factories. And they have helped convert some businesses to worker co-ops, such as Equinox Woodworks. This is a book I mentioned, Finish Big by Bo Burlingham. I recommend that to all business owners thinking about business succession planning, because he really talks about how you want to feel after you have transitioned out of your business, and making sure both that you sell to, that the transition is the way you want it, whether that is an outside sale or a sale to the employees, that it's something you're going to feel good about. And then also that you have a plan for what you do after you retire. Another great book is How to Run Your Business So You Can Leave It in Style by John Brown. Mountain BizWorks Market Advisors does some assistance and some valuations and financing in Western North Carolina. The National Center for Employee Ownership is a fantastic national group with a lot of educational resources. They're very heavy on ESOPs, but they have a little bit on co-ops and EOTs. Becoming Employee Owned is a good resource with a lot of case studies. The Family Business Institute for those who are transitioning family businesses. The statistic I've heard is that businesses tend to stay in one family for about 3 generations, and then they transition out. So that's a good thing for business advisors to know. EOT Advisors is a great group that helps with EOTs. And then your group, Katie, remind me the name.
Common Trust.
Common Trust. I need to add you in there. The Common Trust can also help with EOT transitions. So these are just a few fantastic resources. The ESOP Association is another one. So let me open it up for any questions. Katie or Carol. All right. Any key takeaways that you want to come off mute and say or put in the chat? One thing you learned today.
Sorry, I couldn't unmute it. My phone was being contrary. No, I have a lot of questions, but I think I need to deep dive a little bit more. It was interesting to know that you had to have a certain number of employees to do the main ESOP one, which I did not know. But just, you know, lots of things. I might at one point do some one-on-one with you, whether I can email or call you.
Absolutely.
Okay. Okay, good.
Here's my
You're
email.
right.
Yeah,
Okay.
acbroughton@nceoc.org.
Let me see. I did a lot of screenshotting sometimes, even though I could go back and listen to it. It's good to have that at your fingertips.
Absolutely. And tell me who you're with, Carol?
So Carol Flowers is my name, and we own F&H Print Sign Design. So we are a company that does screen printing and we do signage. We have been self-employed for 29 years, going on 30 years in January.
Okay.
It is a business that has 3 partners. 2 of the partners are myself and my husband. And we are just trying to see what our next steps are when it comes to retirement, because it's something that's on the forethought of our minds.
Got it.
So
Well,
just trying to explore, you know, all the things just to kind of see which way we're going to go. I've already talked to a company who, you know, evaluates your business and then tries to put it out there for sale. Our building is 12,000 square feet, and my husband and myself own the building. And then we have our business in 6,000 square feet in the middle. And then we have rentals. We rent to the Army, Navy, Marines, which is a good tenant. We have a yogurt shop and a recycled bookstore. So we
wow.
also have the potential to sell the building and then have potential income for somebody else as well. So not complicated, but it's not complicated. And just trying to see what the best fit will be, even as far as the taxes are concerned.
Yes. And where are you located?
We are in Elizabeth City, North Carolina.
Gotcha. Well, I'd be very happy to have a one-on-one with you and point you to any resources.
And so my daughter actually works at College of the Albemarle
Okay.
in the Small Business Center.
Okay.
And so she's the one who sent the information to me about the seminar that was happening today.
Okay. Great.
And thank you.
Yeah, thank you, Carol. Nice to meet you. Katie, any takeaways?
No, I mean, you know, I work in this space, so I think succession planning is just a real pain point for a lot of my clients. And so I was hoping you were gonna like drop some epiphany on me. But I think it's just hard, and doing the work and doing it early is important. So kind of no, but just validating a lot of the things that I see with my clients as well.
Gotcha. Yeah, I try to go through step by step of the things you need to think through and plan for.
Yeah.
All right. Well, thank you all for being here. And yeah, feel free to contact me if you have questions.
Thanks, Anne-Claire. Talk to you tomorrow.
Okay. Take care.
Thank you.
Thank you.
Bye-bye.
Bye.